If you think this week was just another quiet September in the markets, think again. We're witnessing what could be a pivotal moment in global finance. Major indices are tumbling across the board. The Federal Reserve is facing unprecedented pressure from multiple directions, and global growth forecasts are painting a picture that could fundamentally reshape your investment strategy for the next decade. The Dow dropped 250 points. Bond yields are approaching levels we haven't seen in years, and behind closed doors there's serious disagreement about the direction of monetary policy. But here's what the mainstream media isn't telling you. This isn't just market volatility, it's the convergence of forces that have been building for months. Stay with me for the next few minutes because what happened this week could directly impact your financial future, and I'm going to break down exactly what it means for your portfolio, your mortgage, and your job security. Let's start with the carnage in the markets because the numbers tell a story that goes much deeper than simple profit-taking. The Dow Jones Industrial Average plummeted 250 points. That's a 0.6% drop that wiped out billions in market value. But that's just the beginning. The S&P 500, which many consider the true pulse of American business, suffered its worst single day in over a month with a 0.7% decline. Think about that. We're talking about 500 of America's largest companies all moving in the same direction, and that direction is down. The Nasdaq, home to all your favorite tech giants, tumbled 0.8%, which might not sound dramatic until you realize we're talking about trillions of dollars in market capitalization. But here's what's really driving this sell-off, and it's not what most people think. Yes, rising bond yields are part of the equation. When the 30-year Treasury yield approaches 5%, that's institutional investors telling you they're demanding higher returns for longer-term commitments. But the real fear factor? Uncertainty about potential new tariff policies that could reshape global trade. Here's why this matters to you. When markets move like this, it's not just day traders losing money. Your 401k, your pension fund, your college savings plan, they're all feeling this impact. And if you're thinking about refinancing your home or taking out a business loan, those rising yields are going to hit your wallet directly. The bond market is particularly interesting right now. After a recent slide that pushed yields higher, we saw Treasury bonds bounce back slightly, but that bounce feels more like a dead cat bounce than a genuine reversal. Smart money is watching the yield curve like a hawk right now. Now let's talk about what's happening behind the marble columns of the Federal Reserve, because there's a power struggle brewing that could determine the direction of the American economy for years to come. The catalyst for all this drama: job openings just dropped to their lowest level in 10 months. Now, if you're just looking at unemployment numbers, you might think the job market is still strong, but job openings are a leading indicator. They tell us where the economy is heading, not where it's been. And right now they're screaming that employers are getting nervous. The market's response was immediate and decisive. Traders are now almost fully pricing in a Federal Reserve rate cut this month. We're not talking about a maybe or a possibility. The futures markets are saying it's practically guaranteed. But here's where it gets really interesting. Projections show at least 2 more reductions in 2025, which would represent a dramatic shift in monetary policy. But behind the scenes, there's serious disagreement at the highest levels of government about how aggressive these cuts should be. And I'm talking about disagreement that could reshape the Fed's independence. On one side, we have calls for a massive 300 basis point cut. That's 3 full percentage points, which would be the most aggressive monetary easing we've seen since the financial crisis. On the other side, Treasury officials are advocating for a more moderate 150 basis point reduction. Now, 150 basis points is still significant. That's 1.5 percentage points that would ripple through every corner of the economy. Your mortgage rates, credit card rates, business loan rates, savings account yields, everything moves when the Fed moves. But a 300 basis point cut? That would be like throwing gasoline on an economic fire, for better or worse. And here's a piece of insider information that most people don't know. Christopher Waller is being seriously considered as a potential replacement for Chair Powell next year. Waller has been one of the more hawkish voices on the Federal Open Market Committee, meaning he generally favors higher rates to combat inflation. If he takes over, we could see a very different approach to monetary policy. What does this mean for you? If you have variable rate debt, credit cards, adjustable rate mortgages, home equity lines of credit, rate cuts are your friend. But if you're a saver relying on interest income, or if you're worried about your purchasing power being eroded by inflation, aggressive rate cuts might not be the gift they appear to be. Let's zoom out and look at the global economic landscape, because what's happening in America is just one piece of a much larger and more concerning puzzle. The latest projections show global growth at 3.3% for both 2025 and 2026. Now, if you're not an economics nerd, that might sound perfectly acceptable. But here's the context you need. That represents a fundamental shift in how economists view the world's economic potential. Here's what's really telling about these numbers. While the United States got an upward revision, meaning economists are slightly more optimistic about American growth, virtually everywhere else in the world is being revised downward. Think about what that means. The world's largest economy is expected to perform better than anticipated, but the rest of the global economy is struggling to meet even modest expectations. But some regions are facing prospects that are genuinely alarming. Growth is expected to weaken to just 2.3% in 2025, and that's not a typo. That's a significant downgrade from previous forecasts. We're looking at what economists are diplomatically calling a tepid recovery in 2026 and 2027, which is professional speak for things are going to be rough for a while. So what's driving this global economic malaise? Three major factors: policy uncertainty, trade restrictions, and the persistent specter of inflation that central banks around the world are still fighting. Policy uncertainty isn't just about elections or regime changes, it's about the fact that governments worldwide are struggling to coordinate their economic responses. When major economies can't agree on trade policies, currency management, or even basic fiscal coordination, businesses postpone investments and consumers postpone major purchases. Trade restrictions are the silent killer of global growth. Every tariff, every trade dispute, every supply chain disruption creates inefficiencies that ripple through the global economy. And here's the thing about trade wars: there are rarely winners, just different degrees of losing. And then there's inflation. While some countries have made progress in bringing down inflation rates, the underlying pressures remain. Energy costs, food prices, housing costs, the things that actually matter to regular people, these are still elevated in most developed economies. I want to spend a moment talking about something that doesn't get enough attention in mainstream financial media: what's happening in emerging markets. These economies often serve as the canary in the coal mine for global economic health, and right now that canary is looking pretty sick. Emerging market currencies are under pressure, capital flows are becoming more volatile, and debt servicing costs are rising as global interest rates remain elevated. When developed economies struggle, emerging markets don't just catch a cold, they get pneumonia. And what happens in emerging markets eventually comes back to affect developed economies through reduced demand for exports, supply chain disruptions, and migration pressures. So let's connect all these dots and talk about what this convergence of factors means for your financial life. We're witnessing the intersection of domestic monetary policy uncertainty, global growth concerns, and market volatility that creates both risks and opportunities. For investors, this environment demands a more nuanced approach than the traditional 60-40 stock-bond portfolio. With bonds yielding near 5% and stocks facing headwinds, diversification becomes crucial. Consider sector rotation. Defensive stocks like utilities and consumer staples often outperform during economic uncertainty. International diversification also becomes more important, but you need to be selective about which regions and currencies you're exposed to. For homeowners and potential homebuyers, the rate environment is creating a unique situation. If the Fed cuts rates as aggressively as markets expect, we could see mortgage rates drop significantly. But that same monetary easing could reignite inflation, particularly in housing markets that are already stretched. If you're thinking about buying a home, you might want to wait for rate cuts, but if you're thinking about selling, the current environment might be more favorable. For small business owners, access to credit is about to become both cheaper and potentially more restricted. Banks are already tightening lending standards even as the cost of money decreases. The key is to shore up your credit profile now, before economic conditions potentially deteriorate further. And for anyone approaching retirement, this environment requires careful consideration of sequence of returns risk. Market volatility combined with potential inflation means that traditional retirement withdrawal strategies might need to be adjusted. This complex economic environment is exactly why staying informed gives you a real competitive advantage. The decisions you make in the next few months could determine your financial success for years to come. If you found this deep dive valuable, hit that subscribe button and ring the notification bell so you never miss our weekly economic analysis. We're one of the few channels that gives you the real story behind the headlines, without the sensationalism or political spin. I want to hear from you in the comments. Are you more concerned about market volatility, potential rate cuts, or global growth slowdown? And more importantly, what specific topics would you like me to cover in next week's analysis? I read every single comment and often feature your questions and insights in upcoming videos. Also, if you're interested in more detailed analysis, check out the description below for links to the economic reports I referenced today, plus my recommended reading list for understanding global economics. As we wrap up this week's analysis, remember that we're living through a pivotal moment in economic history. The decisions being made in central banks around the world, the policies being debated in government chambers, and the investment choices being made by institutional investors, all of these will shape the economic landscape for the next decade. This week proved that in our interconnected global economy, understanding the bigger picture isn't just intellectually interesting, it's financially essential. The convergence of Federal Reserve policy, uncertainty, global growth concerns, and market volatility creates both significant risks and unique opportunities for those who understand what's really happening. The key takeaway? Stay informed, stay flexible, and remember that in volatile times like these, knowledge truly is your most valuable investment. The investors and business owners who understand these macro trends will be the ones positioned to thrive, while those who ignore them risk being left behind. I'll see you next week with another comprehensive analysis of the economic forces shaping our world. Until then, invest wisely, plan carefully, and never stop learning.